Hello everybody and welcome to this macroeconomic video on market-orientated supply-side policies. And here I just have some examples of some market-orientated supply-side policies in our three different markets, the labour, capital and goods market. So firstly, let's look at the labour market. Now, aims of supply-side policies in the labour market are to increase the supply of labour, so to make as much labour available as possible. And the idea is, assuming this labour has jobs to go to, these people have jobs to go and work in, there will be greater levels of outputs, therefore greater levels of economic growth. Now this can be done by reducing the power of trade unions, so that means that people will strike less often, therefore there will be a more stable supply of labour. Also, if we reduce the immobility of labour, so we prevent geographical and occupational immobility of labour, that means there is a greater supply of qualified and able to move around labour, so therefore these people can take more jobs and produce more. Next we have keeping the minimum wage low, and this has the aim of, if the minimum wage is low, then this encourages firms to come and employ workers because they're cheaper to employ. But if the minimum wage is high, firms wouldn't employ as many workers because the cost of employing them is incredibly high. So if we keep the minimum wage low, there will be a greater demand for labour in order to meet the supply of labour, therefore our output will be maximised, as will our economic growth. And our final 3 points are all to do with the poverty trap and preventing the poverty trap. So the poverty trap is the whole idea that if I were claiming benefits, and let's say I was getting 10,000 a year from claiming benefits, but then if I went and took up a job, I lose those benefits and I am now taxed on the wage that I earn. So let's say after I lose my benefits and after I'm taxed on my wage, I can now only earn £10,100 a year. So the poverty trap is when people will either be not really any better off by taking a job, or in fact be worse off. And therefore this gives people the mentality of, oh, why should I go and work, say in that case, that extra £100, is it really worth it? So therefore, to prevent this, to get people to go and find work and get them employed and producing and maximising output, if we keep tax low, so people get to keep more of their wages, so essentially wages are going up, so for example I might get to keep 13,000 this time, and if we reduce state benefit to say from 10,000 to 8,000, what that means is, by these two policies, I've created now a £5,000 income gap between the unemployed and the employed. So therefore this encourages the unemployed to go and find work and therefore start producing in order to encourage economic growth. Our next supply side policies are in the capital market. So these have the aim of increasing the supply of capital. So if we have more physical capital, more machinery, more human capital, so better trained and educated workers, we will be more efficient, we will produce more, there will be more output and therefore greater levels of economic growth. And our main way of doing this is encouraging investment. And we do this by two different methods. Firstly, if we lower corporation tax, so corporation tax is how much of a business's profit they have to pay for the government. If we lower this amount, businesses will have more profit. This means they have more money to play with, so therefore they are more likely to invest this money, therefore resulting in increased capital, increased productivity, increased output, and therefore greater economic growth. Also, if we increase the availability of finance, so for example if we give banks an incentive to lend to businesses, that again means those businesses have more money, they'll invest, therefore increasing the amount of physical and human capital, therefore increasing output and economic growth. Next we have supply side policies in the goods market. Now supply side policies here have the aim of increasing competition so that everybody has to work in the most efficient way and produce the most, and in this way we maximise output and therefore economic growth. So if we increase competition, this forces bigger firms to be price competitive. This forces them to keep their prices down so people keep buying their goods. And also it encourages small firms to become more efficient, to try and rival the bigger firms. So examples of doing this are, if we encourage free trade, that forces businesses to work in the most efficient way by trying to find their resources from the cheapest places possible, and this allows us to maximise output again. Also, if we encourage small businesses, for example, encouraging enterprise incentives, so essentially if we encourage people to start small businesses by, say, subsidising them or giving them a reward, then This encourages them to be incredibly efficient, it increases output and productivity, and therefore economic growth. Also, if we privatise businesses, so what this means is if the government owns a company, so say for example Royal Mail, and then it sells Royal Mail to private investors, and this process is known as privatisation, so the selling of publicly owned companies, then what this does is this essentially introduces a new big player into the market. So we introduce Royal Mail into the big parcel and posting market, and this encourages all the other businesses in that market and Royal Mail as well to be as efficient as possible in order to keep the most business. So therefore, by being as efficient as possible, they produce as much as possible, so therefore output is as high as possible, so economic growth has been maximised. And finally, deregulation, or the reduction of red tape. Red tape is sort of the administration processes businesses have to go through all the time. So if we reduce all those administration, time-consuming, expensive processes, or deregulation, cutting red tape, then we encourage them to produce lots and lots more because it's easier and cheaper for them to do so. So therefore, if they're producing more, there is more output and therefore greater levels of economic growth.